Very good evening to every one of you. Thank you so much for coming on the webinar and to listen from the experts, tax experts, Nexdigm, a part of SKP. Along with me from Indo-American Chamber of Commerce, we have Mr. Surendran, our chairman of South India Council, my colleague Vice Chairman, Mrs. Vijay Saigaru, and Mr. Ram Kumar, and my colleague Shika. Welcome you all once again. I'm sure this lockdown 4 has just begun to end of the main lockdown, and by June first week, most of us will be in action. Thanks to the government of India and thanks to the state governments who allowed most of the prime economy generators companies to start their industries much before, even during the lockdown. In the mid of May, the essential commodities, pharmaceuticals, which are very essential. And we have a huge scope. This particular COVID has shown us a learning. At the same time, we have a lot of things to gain from it. Most important thing, what is the gain? It is only gain, gain, and gain. Gain in terms of fine-tuning ourselves, retrospecting and fine-tuning, we have plenty of time. Number two, just looking at giving it, the entire COVID gave us an opportunity to look at the entire global economy. You talk to every second person that they're talking about global economy. That's a good sign. They may not be economists, they may not be strategists, but it is a good sign. That means everybody are talking the same language. That is what we require. Because we know how boring, we used to feel when we were in college, when you go to economics. Most of us used to bunk economic class. But today, even in the dining table, we are talking about economics, the taxation part. So we know the importance of it. Coming back to the present day, the session what we're talking about is, it is more about a recent tax amendments the government has given. How you can enable your business, how can you use them for the business continuity. We thought, ISCC, when Nexdigm SKP people approached, we thought it is a very, very essential subject, very important subject, because most of people have been, because we've been listening to a lot of announcements from the finance minister and the government also, but some kind of ambiguity, some kind of apprehension did happen. So this, I'm sure, end of this particular seminar, most of your apprehensions will be cleared. We have experts from SKP, Mr. Neeraj Sharma, Mr. Bhadras Vyas, Mr. Lucky Ahuja, all experts in their own taxation subjects. I'm sure they will clear their doubts. And before going to the main session, I would like to also tell you that now India has got a lot of opportunities. I'm not talking about China as a story, but India has got a lot of opportunities. The first reason being the way India contained this particular global pandemic. It was very, very challenging. You have learned and seen so many deaths happening in Europe, so many deaths happening in the US. Comparatively, the Indian government was very, very successful in containing. So that was the best part, and it made India look at this different country in the global market, global scenario. That helped us a lot. That helped us a lot in sense ease of doing business. When government can handle this kind of pandemic in such a beautiful way and with less of deaths, that was very, very well appreciated also. As you know, the countries like Japan, Korea, they are also appreciating and encouraging encouraging the manufacturing units, their investors, to go to India and set up their units. That's a very good sign. Such is the scenario. In such scenario, when the globe is looking at India, what is that we have to do? Are we prepared? So my answer is yes, we are prepared. Whatever the Prime Minister was talking about, we are supposed to do a self kind of a thing, Atmanirbharta, whatever he is saying. That has been happening over a period of time, not now. For the last 5 years, we talk about Make in India, Digital India, Skill India. So we are prepared. Talking about logistics, we are prepared. Talking about connectivity, we are prepared. So people are looking at India as a safe country, health, and at the same time making good health, maintaining good health and making wealth also. So in the recent budget also, Our main budget was wealth creation. So all these things have come at right time. COVID at a wrong time, but we are going to take all positive points about what this negativity. Having said that, next scenario is how India is, where India is lacking. We are, yes, we are, there are certain things where we are supposed to fine tune. For example, when you're talking about FDI coming into India, so what is that you're supposed to? We are supposed to, from country to region, country to country, because we are all then globally we have signed a pact with WTO. We respect that and govern. We respect that and we go through that particular governance of WTO. In such case, the government is coming forward and tweaking such kind of wherever FDIs are required, so that free flow of FDI can happen into India. So what I'm trying to say is, the government of India is also looking at it and they're doing it very positively. And one more major important thing is the special economic zones. Now, right now in India, apart from the schemes, we have only one particular act, the Special Economic Zones Act of India, which has enabled to bring in good number of FDI. It is a game changer. Having said that, people have been, the last 3-4 years, people thought, that the sunset has already come for SEZ. It's not sunset on SEZ. It is a sunset on only one particular clause of special economic, that is on the income tax part. That is coming to this thing from March 31st, 2020, and that is extended to which people already obtained LOI. That is extended to June 30th. Even in spite of missing out the income tax incentive, still the companies, larger companies or smaller companies, when compared to their turnover, whatever loss they are making as income tax is very, very minor. So you still continue to get the indirect tax benefit. So nearly, for example, we at Phoenix, we are able to save around 18 to 20% on capex investments. That is a very good sign. So we're talking about larger picture. Nobody would really look at the income tax part of what kind of benefit they are getting it. So these are all the positive factors. Now we keep on hearing South Asian countries, all these people like Vietnam, Cambodia, Philippines, all are taking up. No, India is a different set of country. Those people do not possess the kind of strengths we have. So India is looked at a different allied country. We let us not bother about traffic move to those countries. We are more bothered about how we can attract, and people are coming to us. Those days are gone where India is at the market. It is up to we are supposed to do it. So I'm very happy to say that we are on target. The government is also going in the right direction. The industry is welcoming the investments, and it's not only one sector, all sectors. We talk about, so it is going to be a shift from service industries to manufacturing. I will not say traffic will be lost in service. Service will have its own place. Right now, in India, service industry is the main cash cow earner as far as exports are concerned. In the coming years, 4 to 5 years, we'll certainly see with the ease of doing business and cost of doing business coming down and favorable environment created to the government area, I'm sure we will certainly see a very good investments coming into India. With this, I hand over my next speaker to Mr. Neeraj Sharma, a Senior Executive Director, Direct Taxes and Regulatory. So during this session, after the session, we'll also open up a question and answers. We will definitely clarify your doubts in case you have. So over to Mr. Neeraj Sharma.
Thank you, Mr. Badiga. Thank you so much. And as you rightly pointed out, there is definitely a difficult time for all of us, but at the same time, there is a big opportunity, not only for the businesses, but for the governments also. And I was reading the CEO magazine a couple of days ago, and I found that there was a list of the top 10 countries which will be most most investment friendly destinations basically, and I found that India is at number 5 position, and it is only because of the way the country has handled the COVID situation, thanks to Prime Minister Modi, that he took the steps bang on time. They say that stitch on time saves 9. So that corollary, I think, goes absolutely true for our country. And as I said, this is a big opportunity for the businesses also, because new business models are emerging. people are working out and trying to operate in such a way that the costs are going down. They are making the best of the available resources. And having said that, what the government has done so far, I would not say it is enough, but what I would say, this is significant. Especially talking about the 20 lakh crore package that was announced, it was one of the largest in the history of the country, and I think in the world also. Next slide, please. And if we look at the way the government is moving, we find that a lot has been done so far. The challenges that we faced are, it is definitely hampering the GDP worldwide. I was just reading a minute ago that RBI Governor Shaktikant Das has reduced the repo rate by another 0.4%, and he said that the GDP growth rate would be in negative during the financial year 2021. COVID-19 has, created a big problem for the supply chains, has hampered the businesses also. Next slide, please. A very quick overview of what has happened because of the COVID-19 situation. The direct tax collections have declined after 20 years. If we look at withholding tax collection, they have gone down by 22% in the first 10 days of May. GST collection has also gone down. It has gone below 1 trillion mark in the month of March. Similarly, other corrections of the government in terms of stamp duty and everything else also has gone significantly down because of the COVID situation. Next slide, please. As I said about the relief measures, I don't know whether they have done a appropriate measures or not, but significant steps have been taken. The 20 trillion relief package that was announced on 13th of May, with a special focus on MSMEs. As a matter of fact, MSMEs contribute to about 30% of GDP, and that's one sector which needs a focus. RBI has not left behind. RBI has also given a 3 months EMI moratorium. And the good news is, just a minute ago, RBI has increased this 3 months moratorium by another 3 months. So initially it was for March, April, and May, and now they have extended till 31st of August. In terms of the exports that the Indian companies are making, there is a timeline of 1 year to realize those proceeds. But the government has said that any exports that are made up till 31st of July, the timeline to realize those proceeds will be 15 months. Similarly, there have been extension in the compliance dates, linking of Aadhaar and PAN, that the date was 31st March, that has also been extended to 30th of June. If we look at the overall relief measures that have been taken by the government, I would put them into 3 baskets. The first, where they have tried to create liquidity in the hands of the businesses. 2, where they have created and given some leeway to the taxpayers and to the businesses in terms of their compliances. And third are other measures where they have tried to improve the overall picture of the country. Number 1, let me talk about MSMEs. A very quick overview. MSME receivables, the government has said that all the government dues and central public enterprises dues will be released in the next 45 days. The MS have been given collateral-free loans. Another facility of subordinate debt has been extended to MSMEs, and a fund of 50,000 crore has been created for the MSMEs, which will ultimately, the funds will be infused in the MSMEs to create liquidity in their hands. Next slide, please. Well, coming to direct taxes, as I said, the measures are 3 types: liquidity and convenience in compliances and other measures. For creating the liquidity, the government has given a very big relief by reducing the withholding tax rate by 25%. Now, any type of payment, supposing a particular type payment of, let's say, professional services was suffering a withholding tax of 10%, it will come down to 7.5%. Similarly, other withholding taxes also, every rate will cut down by 25%, and this will bring some additional funds in the hands of the taxpayers, and this will continue till 31st of March 2021. Another big thing which government has done is in terms of issuing instructions to the field officers and tax officers, saying that they should not do any communication with the taxpayers where it will create an adverse impact during this period. Secondly, they have said all the rectification applications which are pending, or any appeal effect order that are pending, or any compounding applications or issuance of refund up to 5 lakhs, this should be disposed of by 30th of June. And in respect of the delayed payment of income tax, where several payments are there between 20th March and 30th June, all those delayed payments will attract a lower rate of interest, which normal situation it is 12% or 18%. It will be reduced to 9%. That means it is 0.75% per month. And on top of that, what has been done is that in respect of delayed payment of taxes, not only the taxpayers will be liable to lower rate of interest, they will not be subjected to any penalty or prosecution for such cases. Next slide, please. One more thing which has come as a welcome step, and this is about the lower or nil withholding tax order. The taxpayers normally, if they feel that in a particular year they are not making enough profits, and the withholding tax that is deducted at source by their payers, it is more than the tax liability, they apply for a lower withholding or nil withholding tax order, and based on that, a lower deduction is done by the payers. Now, because of the COVID situation, the taxpayers were not in a position to make the application for lower withholding tax orders. So government has done very proactively. They have extended the validity of the orders that were issued during financial year 1920 to the financial year 2021 also till 30th of June. In respect of non-resident taxpayers, where they have a permanent establishment in India, there was no tax rate or they were subject to 40% tax rate. A 10% rate has been prescribed. Similarly, in terms of other measures in respect of the PF contributions, where the wages are below 15,000 rupees and those establishments have up to 100 workers, the benefit has been extended up to August 2020. And in respect of other cases, the withholding of PF by both employer and employee has been reduced from 12 to 10%. As I mentioned, the first measures that we talked about until now, they were primarily for the purpose of increasing the liquidity in the hands of the taxpayer. Now we'll talk about the relief measures which have been done for easing the compliance burden on the taxpayers. The first of such is there was a scheme of dispute resolution, which is direct tax Vivad Se Vishwas scheme, which was announced after the budget. In this, the due date was 31st March, which was extended to 30th June. And now this date has been further extended to 31st December 2020. And initially there was a payment of 10% additional tax which was to be made if the payment was to be made after 31st March. This 10% additional payment has also been waived. That means anybody who wants to avail the scheme and he wants to do that, then he can make payment up to 31st of December. There has been relaxation in respect of the revised returns also, which for the financial year 18-19 that were to be filed by 31st March, they can now be filed up to 30th June. In respect of the tax returns for financial year 19-20, there were three different dates, that is 31st July, the second date was 30th September, and both these dates have been extended to 30th of November. That means all the returns that are to be filed for financial year 19-20 can now, without any consequences, can be filed by 30th of November 2020. Similarly, the tax audit report date has also been extended by 1 month. Further, insofar as the assessments are concerned, there were certain assessments that were to be completed by 30th September. The date has been extended to 31st December in all those cases. And where the assessment was to be completed by 31st March 2021, those dates have been extended to 30th September 2021. That is not all. There are few more measures which have been done, and this is regarding the residency rule. So, as you know, because of the COVID situation, what has happened that a lot of people overseas, in terms of NRIs or who were non-resident foreign citizens, they came to India, and because of the COVID, they could not go back. and because of the fact that they were forced to be in India because of the lockdowns and non-operation of flights, their residential status could have undergone a change. Means they were planning that they would remain a non-resident, but because their stay in India was forced to be there, so their status would change, and relaxation has been given in so far as the period for which they will be here in India, due to the forced circumstances, that period will be ignored for computing the 182 days criteria for computing the residential status. This is applicable only for financial year 1920. For financial year 2021, the government will be further announcing, making the announcements depending on the situation as it remains. Next slide, please. This is one big amendment that has come, and that is regarding the 10AA units who were supposed to start the manufacturing by 31st of March 2020, but that manufacturing could not be started. In such cases, the date has been extended to 30th June 2020, but only in respect of those cases where a letter of permission has been obtained before 31st of March 2020. If letter of permission comes after 31st March 2020, then this relaxation will not be available to them. In the due dates for various procedures under income tax are concerned, whether this is filing of appeal or application or reply to a notice or any notice to be issued by the authorities, the government came up with a ordinance, and these were promulgated in the month of March itself, on 24th of March, and dates of all these things, compliances by the taxpayers or issue of notice by the government under section 148, etc., all those dates have been extended to 30th June 2020. And this is not just a notification, it has carried the law of force of law, because this is through an ordinance passed by the government through the parliament. This is a welcome relief which is in respect of the investments which individuals and companies make, especially in ATG for making donations. Similarly, individuals make investments in public provident fund and life insurance policies under section 80C. Similarly, for saving tax on the capital gains, the investments are made in several schemes, and these investments qualify for exemption under section 54 to 54G. This is a big benefit because normally these investments, if made within the financial year, only then they are eligible. But now this date has been extended to 30th June. That essentially means that if you are making an investment under section 80C, 80G or 54, even though after 31st March 2020, but it will still qualify for benefit in the financial year 1920 only. You and I are aware that there was a special fund created to fight with the COVID situation, which is PM CARES Fund. This is eligible for 100% deduction under section 80G, and it also qualifies for CSR spend. So similarly, any spend made, any donations made to PM CARES Fund up to 30th June will also be eligible for deduction under section 80G within the financial year 1920 only. There was a requirement in this financial year, in this budget, that the trusts and societies who are registered under section 12AA, they will have to do certain compliances, and the date, considering the COVID situation, has now been extended to 1st of October 2020. That means these amendments will be applicable from 1st of October 2020 only. Coming to the third part of measures, as I said, the first one was regarding improving the liquidity position of the businesses. Second were about easing the compliance burden, and the third is about the other measures. And as I said, MSMEs is one of the sector which is contributing to 30% of GDP, and it required a special treatment. And this is through this 20,000 crore package, which has been 20 lakh crore package that has been announced by the government. It is a big job which has been done, and it comes as a major relief to the MSME sector. The first of this amendment is that the distinction between service enterprises and the manufacturing enterprises has been done away. So there is no differentiation. Second is the limits of investment in these sectors, and the turnover limits have been increased significantly. For the micro enterprises, which used to be 10 million, it has been increased to 50 million. It has been increased to 10 million, sorry. For small and medium enterprises, which used to be 50 million, it has been doubled to 100 million. For the medium enterprises, which used to be 100 million, it has gone up to 200 million. This is for investment. Similarly, turnover criteria have also been increased very significantly, and it is a very, very welcome move. I believe a substantial number of MSMEs would like to avail this benefit. Some more has been done for the MSME sector, and this is regarding that they will be given the benefit of e-market linkage to bring sellers and consumer on the same place as a replacement for the trade fair, which cannot be done due to the COVID situation. And insofar as the insolvency law is concerned, the threshold was 1 lakh. It was initially extended to 1 crore to give relief because of the COVID situation. The government has announced that a special insolvency resolution framework for MSME will be notified soon, which will be applicable especially to MSMEs. Apart from the other benefits that are applicable under general criteria, there will be some special benefits coming to MSME. Now, there are some practical challenges as we see, some relief measures have been given, and because of the COVID situation and otherwise also. So because of the global lockdown, there are certain critical situations which are arising, and people, as I said, get stranded in different countries. Similarly, non-resident Indians get stranded in India, and foreign nationals also. While the government has given a benefit that if somebody gets stranded in India because of COVID-19 situation, non-operation of flights, etc., there will be a special treatment, and their period of stay due to COVID-19 will be ignored for computing their personal tax residence. But there is no clarification in respect of the situation where, because of their presence, their companies will be said to have a permanent establishment in India. So that PE exposure is still there for the companies. Similarly, place of effective management risk is also there because of the senior managerial personnel like CEOs and senior management personnel, they get relocated. Another thing is about the interest for late filing of return. Although the date of filing of return, as I said, has been extended from 31st July and 30th September to 30th November, however, it has not been made clear whether the interest for late filing of return, which is under section 234A, will be applicable or not applicable. It is just the date which has been extended, although at lower interest rate, which is 9% per annum, yet that interest is likely to be paid. Next thing is about, while there is a reduction in the withholding tax rate and they have been significantly cut by 25%, still there the problem remains, because while on one hand their liquidity of the businesses will improve, but at the same time what will happen if they are liable to pay advance tax on 15th of June and then 15th of September, 15th of December and 15th of March, then no matter whether withholding tax rates are cut or not cut, they will ultimately be liable to pay the advance tax. So while on one hand there is a relaxation in withholding tax rate, but there is no relaxation insofar as the advance tax liability is concerned. So the problem is partially or partly, or I would say very minusculely addressed by reducing the withholding tax rate. Let's have a look at some quick, amendments that were made recently, and we do not have time to discuss all of them, but I'm going to talk about 2 or 3 of them which are very significant and which are applicable to most individual and companies, taxpayers. The first one is about the dividend distribution tax. We know that until last year, the companies who are declaring dividends, the liability to pay tax on the dividend was on the companies, and they used to declare dividend and pay the dividend distribution tax in the range of 17 to 20%. But this system has been changed from this year. It has been amended by shifting the burden of tax on dividend from the companies to the individual or the investors, basically. Now, henceforth, the dividend distribution tax will not be paid by the companies. It will be paid by the investors, the recipients of dividend. That means the liability on dividend, which used to be at 20%, will vary in the hands of the taxpayers depending on their individual tax rates or their status. Like in the case of a company, it will depend on what tax rate they are opting for, whether it is 22% they have opted, or they have opted for 30% or some other tax rate. And for individuals, it will depend on the bracket in which they are, whether in 10% or 20% or 30% bracket. It has been clarified that any dividend which has been subjected to dividend distribution tax, so there is a possibility that the dividend was declared in the financial year 1920, but actually it was physically paid to the individuals or the recipient investors after 1st of April 2020, when the new regime is in place. So it has been clarified that any dividend which has suffered dividend distribution tax will not be taxable in the hands of those individual investors. It will be exempt in their hands. So that thing has been clarified with the government very clearly. A big benefit comes to the companies, especially those companies who receive dividends from their investee companies, and at the same time pay dividends to their investors. So what has been held that in the case of companies who are receiving dividend and also paying dividend, they will not be liable to pay dividend tax on lower of the amount that is received or paid. Now, assuming a company is receiving dividend of 100 rupees and it is distributing dividend of 40 rupees, so on those 40 rupees, it will not be liable to pay any dividend tax. Now, conversely, supposing it is receiving dividend of 40 rupees and paying out dividend to its shareholders of 100 rupees, again, the lower of the two is 40 rupees. Again, on those 40 rupees, the company will not be liable to pay any dividend tax. Next slide, please. Regarding the dividend tax, the provisions have been rationalized. However, there are some of the issues which come up. The first is about the rate of tax that is applicable. As far as the resident taxpayers are concerned, there is a specific rate of 10% applicable to them. But when it comes to the non-resident taxpayers, there are several problems insofar as determining what rate should be applied. Generally, there is a rate of 20%, but what if somebody wants to claim a treaty benefit, and whether beneficial ownership criteria has to be fulfilled or not fulfilled? Similarly, MLI, multilateral instruments, are also applicable from 1st of April 2020. So it has to be seen whether that benefit will be available or not available. And all of this is creating a lot of burden on the companies who are distributing dividends. Now, we have seen, there are a lot of companies who have thousands of non-resident shareholders. And in respect of those shareholders, not only it is required to go one by one and take necessary documents from those individual shareholders to their eligibility of treaty benefits or MLI applicability, but there is a huge compliance burden also in terms of, because they have to issue a form 15CA and 15CB also, and this creates their life very, very difficult. Assuming the company has got 50,000 shareholders, it will have to file 15CA and 15CB. Even if the payment of dividend is less than 5 lakh, at least form 15CA has to be filed, and that puts a lot of burden, a huge burden on the corporates who are declaring dividend, who are listed companies. Next slide, please. One more major change, and I think this is the last one in my presentation. This is about the equalization levy. Well, equalization levy was introduced in 2016, and this was introduced as a tax outside of income tax. It is not part of the income tax. And the 2016 levy said that the tax liability will be on the recipient of services. Now, a person who is sitting in India who is receiving some services in the nature of advertisement services from a non-resident will be liable to pay additional 6% tax on it, and this is not in the nature of income tax. So therefore, the other party, which is a non-resident party, would not be eligible to claim the treaty benefits. At the same time, it is not of any use for the Indian party also, because it is not available as a Senvet credit, because this is neither GST nor service tax or anything. This is a third levy. Now, on the similar lines, under the same levy called equalization levy, a new tax has been introduced, and this time this rate of this tax is 2%, and this is applicable on situations where the transaction is between a non-resident e-commerce operator and an Indian party. Indian party means somebody who is a resident person in India or someone who is using an Indian IP address. In such situation, the foreign party has been made liable. Unlike the earlier levy, 2016 levy, where the tax rate was 6%, here the tax rate is although 2%, but the burden of compliance and burden of payment of tax is on the non-resident payer. Next slide, please. Although there is an exemption provided under the law that any tax which has on any transaction on which equalization levy has been paid at the rate of 2%, there will be no income tax payable on this. However, the exemption has been provided from the financial year 21-22, whereas this levy is applicable from 1st of April 2020. That means in this financial year, there will be both tax applicable, that is income tax and equalization levy. And as I said that the burden is on the non-resident. I do not know how the government is going to track all these transactions, but it is going to create a lot of problem both for the taxpayers and the tax authorities. There are some issues also in terms of there are certain transactions like royalty and FTS. They seem to fall under the income tax, and at the same time say they seem to fall under the equalization levy also. Now which one to apply? The liability to pay tax on both will be, one will be on the resident party, one will be on the non-resident party. Supposing it is royalty or FTS, the Indian party, the payer is liable to deduct TDS, and if it is equalization levy, it is the foreign party who is liable to pay. So that differentiation is not there, and everybody is grappling to find a solution to it. Similarly, the first compliance that has to be done under equalization levy law is 7th of July. I mean, the first quarter, that is April to June, the compliance has to be made by 7th July by making payment. But there is no clarity right now, and considering the COVID situation, it is expected that the government should come up with some clarification. Similarly, the current provisions imply that it will cover the direct tax, direct sales and services also, whether it is fair or not. Supposing somebody is downloading a software from the website of a non-resident party, so it is not clear whether that download will attract fees for technical services or it will be subject to equalization levy. And if somebody is not using the e-commerce platform, they are using their own website, it is applicable in those transactions also, and whether this is fair or not fair, it is not known. So there are a lot of questions hanging around equalization levy. I'm sure the government will come up with some clarification. And with this, I'll hand over the dais to my colleague Lucky.
Thanks, Neeraj, for sharing the direct tax amendments and the relief measures taken by the CBDT on that. So just like you mentioned that the DT direct tax has a relief measure in terms of the compliances, the liquidity, and other administrative measures. Similarly, in GST also, similar kind of measures have been taken. So to start with the compliances, so late filing fee of GSTR 1 for the month of March till May 20 has been waived off, with the condition that all the GSTR 1 is filed before 30th June 2020. So that is what the compliance relief measure they have given. Similarly, for GSTR 3B, a monthly payment return which is required to be filed has been the late filing for that has been waived off if the 3B is filed within the revised due dates. So what are the revised due dates? We will discuss in the later part of the slides. And the major relief which has been given is for the companies who is having more than 5 crores of turnover. So what government has prescribed that if the payment is made within 15 days of the original due date, there won't be any interest, and the payment is made beyond 15 days, but well within the revised GSTR 3B dates, then the reduced rate of interest, that is 8% as against the 18%, 9% as against the 18% would be levied. So now question is that though government has given a revised due date for 3B, but at the same time they have restricted the benefit of reduced interest rate by 15. So what it is coming out that in order to avail benefit of reduced rate, you must without any interest, you must file your GSTR 3B within 15 days. Otherwise interest would be levied. Now, one more question is that if we file our returns beyond the prescribed 3B dates, what would be the interest rate? So though what it is that the interest would be levied right from day one when it was supposed to be paid to the department. So in that case, the 18% GST, 18% interest would require to be paid to the government. Now, another relief measure which is given by the CBIC is that the validity of e-way bill, which was expiring before between 20th March 15 and April 15th, has been extended till 31st May 2020. So we know that because of the movement was restricted and lockdown was there, so that relief was very much required and required to be implemented. Now we will see the detailed due dates under for 3B in this slide. So if you see for more than 5 crore of turnover companies, the due dates are more or less same. It is 24th June for February, March and April, and for May it is 27th June. But if you see what is required to avail the interest-free benefit is that the tax should have been paid by 4th April for the month of February. The tax should have been paid by the 5th May along with 3B with March 2020. For April, it should have been paid by 4th June, and for May, it should be deposited by 27th June. So in order to avail benefit, you must align your payment with the 3B, and 3B has to be filed if you want to avail benefit. For any company which is having turnover of more than less than 1.5 crore or between 1.5 crore to 5 crore, there is no interest and penalty for that late filing. But the condition is that they need to adhere to these timelines and due dates which have been mentioned. So that is what it is there. So for less than 1.5 crore company, you see the due dates are 30th June, 3rd July, 6th July and 12th July respectively for the period February to May. And for turnover, for companies having turnover between 1.5 CR to 5 CR is 29th June for Feb and March, and 30th June for April, and for May it is 14th July. So these are the kind of a good relief measure has been given by the CBIC to provide a kind of a liquidity to the companies. Please move. Yeah, there are a couple of other general extension as well in that. So what it has been prescribed that whatever compliances or refund which were supposed to be complied or during the lockdown period has been blanketly extended till 30th June. So what could be the cases where the compliance dates were required, like refund, which was time barring on 31st March. Now we can file the refund claim till 30th June 2020. Now similarly, any show cause notice which was received and was supposed to be replied back between the notice between the lockdown period has also been extended till 2020. So all this extension has been given by the department to make sure that the assessee is not suffering because of that. Now, moving on to the next slide, please. Yeah, the major liquidity relief, if we talk about, has come from the requirement of Rule 36(4). So what this Rule 36(4) is that I need to match my credit with the GSTR 2A, which is the GSTR 2A is the return to be filed by my supplier. If those invoices or credit are appearing, I am supposed to take credit. But the Rule 36(4) required that I can claim 110% of the amount which is matching in my 2A. So now that was also creating a lot of problem and lot of credit was required to be deferred to next month because it was not appearing. So in order to avoid any penal interest and all, people were parking this credit and only taking credit which were duly appearing in 2A. Now government has said that this requirement of matching has been deferred or kept in abeyance for the period February 2020 to August 2020. But what an assessee or a taxpayer needs to make sure that in September, cumulatively, they are required to undertake this reconciliation exercise. And then whatever shortfall excess is there, they need to account for in the month of September 2020. Now in that one question arises that what about those credit which was availed, which was not availed or parked for pending credit for the period of October 2019 to January 2020? Can I take credit in this period and again do the final reconciliation on September 2020? Because there is no clear-cut embargo coming from the language that I cannot take those credit and it will not be eligible for this deferment benefit. So we are of the considered opinion that we can take this credit and we can have a thorough reconciliation at the September 2020, and then whatever shortfall is there, we can adjust it appropriately. Now, one more thing which was expected from the government authorities are that they should have clarified if there is any excess credit availed during this entire consolidated reconciliation exercise, whether there would be any interest liability. Though government has not clarified, but we are of the view there is a possible exposure of interest on this part. Department will definitely come after you to recover the interest portion on this part. Moving on to next slide. Yeah, these are the certain other measures which have been given by the department. There is that as per the guidelines given by the Supreme Court, conducting hearing electronically has been prescribed. It is interesting to note that in this particular scenario, the Supreme Court has taken a suo motu cognizance on a self writ. They have given a directives or a guidelines to conduct these hearings on a virtual mode, and this virtual mode, kind of a consideration of this virtual mode was first discussed in the case of the state of Maharashtra versus Praful Desai. So it is a welcome move that government don't want to put the litigation on hold, and they are prescribing this thing. So on the basis of Supreme Court directives, similar arrangement has been made under GST law as well as under customs law. The much talked about Sabka Vishwas legacy dispute resolution scheme, which was already expired. Now the payment option has been extended till 30th June for this particular scheme. So what it means that those who have already opted for this scheme but could not make the payment, for them now it has been extended till 30th June 2020. Another major liquidity measures which has come up in this lockdown period is that the government is pushing for the pending GST refund which was there, or maybe a custom drawback. So government has earmarked around 18,000 crore for expediting the refund claim. And if we believe the social media or a print media, it is believed that approximately 12,000 crores has already been disbursed to the disbursed in the form of custom duty or custom duty drawback and a GST refund. So this is a welcome move. It is expected that it is going to benefit a more than lakh of MSME sector which were waiting for their refund and all. Similarly, the TDS return and ISD return and non-taxable persons return has been extended till 30th June. Accordingly, the TCS payment, which was supposed to be made by 10th of next month, has also been extended till 30th June. But one more interesting point here is that the TCS has not been specifically covered, the payment part. So that is what now interesting to see whether department will also be considering this as an extension for TCS payment. To our mind, as the general exemption has been given or general extension has been given, this should also be considered as an extension, but nothing has been clearly coming out based on the notification issued so far. Now for LUT, we know that in order to claim benefit of export without payment of duty, then an exporter is required to file LUT for with the department. Now every year it is required at the start of the year. Now because of lockdown, this process could not be completed. So government has extended this requirement of filing LUT till 30th June, but with a mandate that the reference of earlier LUT has to be given on the invoices. So that relaxation is having a condition that you need to mention the older LUT on your export invoices. Please move on. Now coming to the custom part, the custom is more or less an administrative measures which has been prescribed. So we know that a few months back, a 24/7 clearance and automated process was started on some of the ports. But now due to COVID lockdown situation, government has extended this to all other ports to facilitate the hassle-free clearance of import and exported goods. Similarly, because of the lockdown, it is possible that the containers might have stuck at the ports and some other areas. And we know that beyond prescribed time, a demurrage is required to be levied on that. So Department of Shipping has given a mandate that the ICDs and CFS and ports on all terminals should not charge any demurrage charges because of that. even they have given a directives to, it is not mandatory, but it's a directive to shipping line as well, not to levy any demurrage charges from the importer or exporter. So that is there. The another interesting part is that on making payment, on making export on payment of GST, sometimes we feel that the invoice number is not matching with the GSTR return and what has been mentioned on the shipping bill. So that creates a particular error called SB005. So now there is an extension of facility for that you can correct in the shipping bill, and so that your refund claim should not be stuck and expedite on that. In terms of the various bonds which are required to be filed with the custom authorities, again, to avoid any hassles of kind of stucking their import and export consignment, government has prescribed that till the time lockdown is over, we may file a simple letter of undertaking with the department through official email ID, and the actual bond and everything can be filed once the lockdown is over. So filing of letter of undertaking has been prescribed till 30th May, but with a condition that the actual bond should be filed by 15th June. So this is as of now position. We might expect this to be extended further as and when the situation demands. In order to have a contactless procedure in place, the out of charge, the electronic system has been put in place for that. So now in customs, what happens that whenever you want to clear your goods, the out of charge bill of entry was required to be filed in hard copy mode, and it was mandated that it has to be signed by the custom officer. Now that has also been done away with. Now everything would be done through online mode, and there is no need to have a final bill of entry to be signed by a custom officer. So digitally signed and email correspondence would be sufficient enough for that. In order to claim the free trade agreements and various agreements we have with the different countries, so that the concessional rate of import duty can be availed. So in that particular case, a certificate of origin is required to be presented by the importer. Now, in order to facilitate that, there should not be any problem. Even the unsigned copy or a digitally signed copy has been prescribed as a valid document for acceptance. But the condition is that till the time the original original certificate of origin is not presented, it would be considered as a provisionally assessed. And once you furnish this original certificate of origin, the bill of entry would be finalized. However, instruction has been given to the authorities that we need to be mindful about the probable misutilization cases. In those cases, department officer has been instructed to implement due diligence and act accordingly. The major relief, we know that all this India is having a shortage of various COVID measures tools like ventilators, mask, PPE kit, and a test kit. So an exemption has been provided from the duties of custom as specified in first schedule, along with social welfare surcharge on these items. So these goods now would be very cost effective in India and can be freely importable on that. And as I mentioned that the government's thrust was very much visible that the refund should be processed expeditiously. Then now in that line, the custom duty drawback has also been put on a faster mode, and it is being processed quite rapidly. So I think that's all from my side. Now there are some key issues which might arise due to COVID-19 situation. So I would like Bhadresh to address these issues which would be relevant for the companies to understand and gear up for future. Yeah. Over to you, Bhadresh. Thank you.
Thank you, Lucky. Namaskar and good evening, everyone. So Neeraj and Lucky took us through what are the amendments respectively under the direct tax and the indirect tax law. What are the relief measures that government of India has pronounced? What I would be covering in next 5 slides is once we start opening our offices post lockdown, what will be some key critical aspects, issues or challenges that we would have to be mindful of. The first is Ministry of Home Affairs has issued a guidelines that everyone who is opening the offices after lockdown would have to provide masks and sanitizers for use of its employees. Now the question arises whether GST paid on procurement of those masks and sanitizers would it be available as an input tax credit or not? So we all know that under GST law, there's a section 16 which lists down the condition that one has to comply with for availing input tax credit, which is receipt of goods, receipt of invoice, you should have filed the returns, and your supplier should have paid the tax. So these 4 conditions would be complied in this case. Then also negative list under the GST law, which is 17 subsection 5. One of the entry in that section is that any goods or services which are meant for personal consumption, input tax credit is not allowed. And we all know that even under the service tax regime, expenditure incurred on catering or snacks or tea or such items of consumables provided to employees, the department was always challenging input tax credit on those items. So here a doubt may arise whether use of sanitizers or masks by the employees, whether it would be considered as for the personal consumption or not. My view is that no, it should not be considered as a personal consumption. One should distinguish use by employee from the term personal consumption. So anything and everything that an employee is using while in the office premises cannot be considered as for personal consumption. It's a mandate, it's a statutory obligation under the guidelines issued by Ministry of Home Affairs to provide masks and sanitizers to employees. So if I have to open my office, I will have to provide this, and this would be considered as for furtherance of our business, and therefore input tax credit should be available. That's the view. Yeah, second slide. Under Income Tax Act, Neeraj explained that Section 80G provides now that expenditure made on CSR activity, corporate social responsibility, would be allowed as a 100% deduction. Now again, the question comes under GST as to whether the GST paid on procurement of those goods and services which are procured as a part of undertaking and CSR activity, whether ITC should be available or not. So here again the view is yes, the ITC should be available, because again CSR for companies, it's a mandate under the Companies Act, and there was also ruling, though under the service tax regime, Mumbai Tribunal's ruling in case of SL Propec, the findings and observations made by Mumbai Tribunal under the service tax regime would equally hold good under the GST regime, and the view is that credit should be available. The question is, if I have to incur a 2% cost as a part of my CSR activity, and I'm taking input tax credit of the GST, then it would not be considered as a 2%. If 118 is the expenditure, only 100 would be then allowed to be considered for that mandatory 2% CSR. So that one thing we will have to be mindful of. But as far as GST law is concerned, input tax credit on goods and services procured for undertaking CSR activity should be available. Another issue that most of the industry foresees that while the lockdown was announced, there could be some raw material which were of a perishable nature, and those goods I have destroyed are not capable of being used now. So what to do with those ITC availed on those goods? So the answer is that input tax credit would not be allowed. Section 17(5) of the GST Act says that any goods which are lost, stolen, destroyed, written up, or disposed of by way of gift or as free samples, the input tax credit of GST paid on such goods would not be available. But now, what happens if the finished goods? So before the lockdown was implemented, we had certain goods which are manufactured using raw material and consumables on which input tax credit was availed. The lockdown was announced, and now those finished goods are not capable of being sold in the market. Those are destroyed. So whether it calls for reversal of an input tax credit of the inputs and consumables which were used in manufacture of such finished goods which are now destroyed. So the answer here, and again, this is my view that it should be, answer is no. ITC section 75 says in respect of goods. So there's a Supreme Court ruling in case of Swastika Tobacco where in respect of has been understood as on. So ITC in respect of goods would have to be understood as ITC availed on goods which are destroyed. Now if these are my finished goods, I have not availed any ITC on those finished goods. I had availed input tax credit on the raw material which were used for manufacture of these finished goods, and those were used for the purpose of manufacture. So I have complied with the conditions of section 16 and not hit by limitation under section 17(5), and therefore for finished goods, if those are getting destroyed, I need not compute what is the corresponding ITC of the raw material or inputs used for those goods. Next slide. One thing, which most of the companies have started giving a thought that while there was a lockdown, commercially the clause of force majeure can be invoked, which means that temporarily some obligations which were required to be undertaken under that part of that contractual arrangement would be suspended because of the COVID 2019 scenario. Now, if I'm suspending my obligation for a part of the period and I'm not making any payment to my vendors, would input tax credit be allowed? So the answer is that yes, if you are making payment within 180 days, yes. But if that suspension is more than 180 days, input tax credit would not be allowed. The law says that on all goods and services on which I have availed input tax credit, I should be ensuring that I have made a payment to my vendor within a period of 180 days from the date of the invoice. So if I am not making the payment, I would not be allowed input tax credit. And if I have availed, I would have to reverse it on 181st day. Another issue that could arise is short termination of contractual obligations. So if I have a contractual arrangement and because of COVID-19, the revised scenarios, economic slowdowns, the impacts, if a contract is terminated and as a part of the contractual arrangement, an amount is paid as a damage or as a penalty, whether that would have a GST implication. Here, two views are possible. There are two schools of thoughts. My view is that yes, it would have a GST implication because paying an amount for short closing or a termination of a contractual obligation would amount to tolerating an act, and tolerating an act has been specifically held as to be a taxable supply under GST law. So if I'm tolerating an act of my other party not fulfilling a contractual obligation for which I am receiving a compensation, that consideration would be treated as towards tolerating an act which is a taxable supply, and it should be having GST implications. However, alternate view is very much possible. Allahabad Tribunal in case of K&N Food Industries has discussed on some of the aspects on this topic, and it was held that a compensation to make good any possible damage which is uncertain, so any amount which is paid which is in the nature of penalty cannot be considered as a supply and therefore should not be having GST implication. But as I said, this view of not paying GST would be prone to litigation, and litigation only up to the top level of judiciary. So considering the amounts involved, one can pay GST on it to avoid on the litigation part of it. Next slide. One challenge which most of the businesses are forcing is in terms of bad debts. So because of COVID-19 and the economic impact of it, there could be cases where customers would not be in a position to make payment and the businesses would have to write it off as a bad debt. So once when I had made supply, I had raised the tax invoice, I had paid GST on it. Now I'm not receiving any amount from my customer. It's a bad debt. would I be in a position to claim that GST which has been paid to the government back? The answer is no. The GST law says that value of a taxable supply would be the transaction value, which actually is the price paid or payable for such supply. So bad debt doesn't mean the price was not payable. The price was payable for such supply, and its GST needs to be paid on those. There was an FAQ issued earlier by CBIC. It was with regard to banking and financial sectors, but it also supported this view that in case of bad debts, the GST paid earlier would be not recoverable again. It would not be allowed to be adjusted. However, if a credit note is issued for a deficiency of supply in service or not providing service or supply of goods as desired by the recipient, then I can very well issue a credit note under Section 34 of the CGST Act, and I can claim back the GST which was paid earlier, subject to certain conditions. So we'll have to distinguish the fact between a bad debt and a credit note issued under Section 34, and depending on that, a call would have to be taken whether GST would be allowed to be adjusted or GST would be a cost. Next slide. Again, similar to bad debt, there could be scenario where some of the business houses would take a call as to offer some special discount only to ensure that the payment is made and we collect the money faster. Now here again the question comes that if I'm issuing a credit note for that amount for a discount to recover the money faster, whether I will be allowed to adjust my GST liabilities. So if I raised an invoice say in the month of January on for 100 and I paid 18 GST on it, now I'm having a negotiation with my customer and I'm saying, okay, pay me 90, I will waive off 10, I will issue a credit note of 10. Now this 10 is a discount to recover that money faster. So can 1.8 on that 10, can I adjust it back? The answer is no. Section 15(3) of the CGST Act says that for all post-sale discounts, post-supply discounts, it can be excluded from the value of supply. That means I can adjust the GST paid earlier only if such discount is established in terms of an agreement which was entered before or at the time of supply of the goods. So because in January when I made that supply, I did not envisage this type of discount, it was not commercially recorded, the discount that I am offering it now would not be in compliance with these conditions of Section 15(3) of the CGST Act, and therefore I would not be allowed to adjust GST which was paid earlier. So if you are taking a call of giving a special discount to recover money faster, you need to be mindful of the fact that you will not be able to adjust the GST which was paid earlier. So it would be a pure financial credit note. You will not be allowed to take the GST paid earlier back from the government. However, here again, we will have to distinguish credit note which is issued under Section 34. So if that discount is in the nature of deficiency or non-supply as per what was of having a pre-agreement, and I can still adjust my GST back. So I'm not suggesting that all our bad dates and discounts, can be taken, given a color of credit note under Section 34. That was not the idea. The point was that there needs to be a distinguishing between the two types of credit note, and one will have to decide GST implications accordingly. So these were some key emerging issues that I thought would be relevant for all taxpayers once the lockdown is lifted and immediately when we start doing businesses. So I captured that. There could be many more, and but these were the key which I could cover. So that's from my side. Now I hand it over to Mr. Vijaya of ISC. Thank you.
I'm sorry, but I think you're not able to hear Mr. Vijaya.
Hello. Is it okay now? Hello?
Little bit
Yeah,
louder,
we
sir.
can a little bit louder, sir. Yes, sir.
Hello. Yeah, my question to Bhadrach, are all the applicable deadlines for USC are automatically extended because of the Hon'ble?
Mr. Vijaya, if I can request you, sir, to increase the volume. Your voice is coming, but it is very weak, sir. Is there a way to increase the volume of your mic or the speaker, something of that sort, sir?
Audible now?
I'm sorry, Mr. Vijaya, but it's the audio is it's not loud enough, sir.
Okay. Just a minute.
Sorry, Mr.
Okay.
Badiga, Mr. Vijaya
Yeah.
talking. Sir. All right. Okay.
Yeah, I'll in the meanwhile, before his mic gets on, I can ask a couple of questions to Mr. Vyas.
Please go ahead, sir.
Yeah, this is from a member. This is regarding GST. Do you think relief measures are appropriate considering the current economic scenarios, or something better could have been done for GST perspective? In continuation, what they're asking is, how do you see the retrospective amendment with effect to July 1st, 2017 in Section 140 of CGST Act, which has empowered the government to specify the time limit for availing such credit, whereas numerous High Court judgments has considered this as a vested right of the assessee? These are the questions from the members. To you, Mr. Vyas.
Sure. So on the first question, uh, has the government done enough or there was a room for more? I would say there was always a room for more. Okay. While government has been proactive enough in coming up with those relief measures under each of the laws, uh, but the economic slowdown coupled with this impact of COVID-19, there could be certain areas, specifically in terms of relaxation from the compliances, right? So as Lucky explained that while the dates for filing returns and all those has been extended, but the real benefit of those extensions would be for taxpayers who have a turnover of less than 5 crores. For all those who have a turnover of more than 5 crore, they will still be required to pay taxes, otherwise there's an interest implication. So the max benefit that they will be able to get is only for 15 days compared to small taxpayers. In terms of small taxpayers and MSMEs, yes, government has done enough. Those are the sectors which were actually looking for relief. There, I would say quite a few supports and steps that have been taken. So what Neeraj also explained in terms of specifically for MSME, changing the definition of MSME, all those obviously would support in a big way. In terms of giving GST refunds faster is something which government is very clear, and they have earmarked specific funds for the purpose of release of refunds, which again is a welcome move both under the income tax as well as under GST. In terms of the second question, which was specifically with regard to retrospective amendment, yes, it's not in a good taste. So we all know that when GST was rolled out in July 2017, the transitional credits under the earlier set of rules, which was service tax or excise or VAT, was allowed to be transferred under GST regime by filing a return which was trans 1. There were infrastructural issues with the network. There were technical glitches because of which quite a few taxpayers are not able to file trans 1. the judiciary has been taking a consistent view that if there's a technical glitch because of which any taxpayer has not been able to file Tran 1, the GST authorities should allow them to file either a manual Trans 1 or should come out with a facility for filing Trans 1. There have been plethora of rulings. While yes, some high courts have held negatively as well, where they have distinguished a technical glitch with a non-compliance of filing Tran 1 within due dates. Delhi High Court last month came up with a ruling in case of brand equity, and which was a very good ruling. The High Court observed that someone who has tried or at least made an effort to file Trans 1, but were not able to submit that because of technical glitch or any reason, should be allowed to file Trans 1. And one point they specifically observed that while there was a due date prescribed by way of GST rules, it was only in the rules, and the GST Act did not have an enabling provision to prescribe a time limit. Because of it, Delhi High Court held that the general timeline which is there of 3 years under the limitations law should prevail, and therefore from 17 3 years counting that by 30th June 2020, they said that if anyone is filing a Trans 1, the authorities should accept that and should allow that credit. And they also observed that it's a substantial right. And one good part was the noting under the High Court ruling, which said not only the writ petitioners. So generally the benefit is available only to the person who filed the petition. Here the court specifically observed that not only to the petitioners, but they issued a direction to the GST authorities to make this ruling public, and anyone who has not been able to claim valid input tax credits under MWAT or VAT rules should be allowed to file Tran 1. Trade and business had welcomed that ruling, but a week later, government came out with a retrospective amendment, and they said that there are these rules which enabling provision was missing under that, which actually was pronounced in last budget, but they notified now as 18th May as the date, and from 18th May those rules have the power. So in a way, the ruling of Delhi High Court has been negated by this retrospective amendment and this notification which has been made, which is slightly not in a good taste.
Thank you so much. Mr. Sai, are you back, sir? Sai, sir? Mr. Surendran?
Yeah.
Mr. Surendran? So do you have any questions to ask?
Yeah.
Yeah.
Good evening, everybody. Myself, Kannad Surendran. Glad to be here in this webinar and be part of this discussion. Indeed, a good idea to connect through a webinar during this lockdown period of. I'm sure this interact will help us build a strong relationship between our IACC members. I was asking one question. There is a concern among construction costs, metro cities, that migrant workers may be not returned to their city of work for another year due to fear of problems arising from COVID-19. This will affect construction activity. What steps will be government taking to ensure the migrant workers return their city of work the earliest?
Question is for whom, Surendran, sir?
Hi. Hello.
Hello. Question.
Niraj.
Mr. Niraj.
Well, I'm not an expert on this subject. I'll attempt this question, sir. Yes, definitely there is a problem, and because of COVID, a lot of workers have gone back. So it has been a reverse migration, and there's a lot of fear also prevailing all over in the minds of these workers, because they passed through very tough times. How they got back home is something very, very, I think it will bring tears in the eyes of everybody, as we have seen it on the TV. Well, as far as bringing them back to the construction sites is concerned, this is something which the government will have to think through. I'm not too sure what measures need to be done, but some sort of believe some sort of assurance will have to be given to these workers that in case such a situation arises again, they will be definitely taken care of in a well manner, and they will not be facing the kind of difficulties they've gone through this time.
Yeah.
I want to ask you one more question. Yes, one more. Hello, Srikanth.
Please proceed, sir. Please proceed. Please ask.
Regarding collateral-free loans to MSME announced by Finance Minister, is it only given to nationalized bank or even the private bank also? Yes.
Well, these collateral-free loans will actually be carrying the guarantee from Government of India, and if it is from guarantee from Government of India, then they should be can be taken not only from the government bank but from the private banks also, because there is a guarantee coming from the Government of India.
Thank you. Thank you, Neeraj.
Thank you, Mr. Vinod. Sir, this question is from Mr. Neeraj Sharma. Mr. Sai was trying to pose this question to you. Sir, he wanted to have a clarification whether the cash flow would really improve due to a reduction in TDS rates, considering that advance tax liability is yet to be discharged. In continuation, in case an order is passed on 1st March 2020, and thus the tax is to be paid between 22nd March and 30th June, would it attract a reduced rate of interest?
Okay, so the first question first, sir. As far as liquidity is concerned, this reduction in the TDS rate by 25%. So in cases where there was a TDS rate of 10%, it will come down to 7.5%. And therefore, this will bring a lot of disposable money to the extent of that reduction in the hands of the taxpayers. But this will be in the interim only, because the advance tax liability also arises. So if we talk about the first quarter, which is April to June, the advance tax liability has to be discharged by 15th of June. So any additional cash flow which is coming in the hands of the taxpayer, it will ultimately be going out in the form of advance tax. However, at the same time, we can see that for the first 2 months, the additional cash flows are definitely there in the hands of the taxpayers, which they can utilize the way they want. So although it is not fully helping the taxpayer, but to some extent it is creating a liquidity in their hands. If we look at this liquidity in line with the lower interest rate that will be applicable for delayed payment of tax, then we find that if the taxpayer is ready to pay 9% interest rate, which would be, I think, substantially low than the interest rate applicable on the bank borrowings, then he can utilize these funds because there are no penal consequences to them in terms of either penalty or prosecution. Coming to the second question, where we talked about any liability, supposing there is an assessment which is happening and the tax liability is arising between 22nd March and 30th of June, there is another view possible. According to me, it will not be subject to reduced rate, because in case of assessment, the tax liability was there on the taxpayer from the day one. It ought to have been discharged during the financial year either through TDS or advance tax, because it has not been paid. Therefore, this is not a new liability which is arising now. It is only being determined now. And therefore, my personal view is that it will not be eligible for the reduced rate of interest.
Yeah, thank you. Another couple of questions from Sasai only. He is asking about whether residency relaxation provided to individuals can be extended to foreign companies for PE determination. And he also wants to know whether equalization levy be applicable on transactions concluded over email.
Okay, in so far as the relaxation in provisions is concerned, because a lot of people got stranded in India and they have not been able to go back because the flights were not operating and the lockdown was there. But unfortunately, the way the wording of the relaxation have been done, this relaxation will be applicable only to the individuals in their individual capacity for determining their individual residency. There is nothing, there is no whisper in the relaxation notification that it will also be applicable for determining the permanent establishment or for determining place of effective management. Regarding the equalization levy, sir, as far as equalization levy is concerned, the language is slightly twisted and it is not coming out very clearly whether it is applicable only to the online transactions or it will also be applicable to the transactions which have undertaken through emails, because the online transactions have been defined in a very twisted way, and if we read it, there is a reflection which is coming that even the email transactions are getting covered, but that does not seem to be the intention of the government, because if we include email transactions also, it will cover every single transaction will come within the ambit of equalization levy. My personal view is there should be some clarification from the government to clarify that the email transaction will not be get hit by the equalization levy.
Thank you so much. Mr. Jugal, you can start with the questions chat box, please.
Sure. Thank you so much, Mr. Parika. There are a few questions from the members. I'll just pick them up one by one. All right. The question that we have is in the new criteria for MSMEs, what is the definition of investment and turnover? What all will be included and what all will be excluded? Over to any of the speakers to please pick it up.
Well, if we look at this definition of MSME, the definition of turnover has not been changed. It remains the same as it was before. Only the thresholds have been changed. So we can refer to the old definition only. There is no new definition coming for computing the investment and turnover.
All right, thank you. Another question that we have is, I think either Bhadresh or Lucky can take this up. Has the GSTIN stopped taking LUT applications for now? We have tried to apply, but we're getting some error. I'm sorry, any comments that you can share, Bhadresh or Lucky? Would you want me to repeat the question? Okay. The question is, Bhadresh, with regards to the GSTIN, has the GSTIN stopped taking LUT applications for now? The member has tried to apply for a couple of times, but there is some error message. Do you have any update on this?
No, so the network hasn't stopped taking anything right now. So maybe it could be because of any other technical glitch. So I'm not sure whether this is for registration, for refund, for what type of this application we are talking about.
I'll see if there are any further comments coming in from that member, Pradesh. I'll keep you posted. Another question that
the general answer is that is GST working? So answer is yes. The network is functional. They have not decided that they will not be taking any applications or anything.
Jugal, I would like to add that probably they need to write to the help desk on that. They need to describe their problem, what is there, and they can get it sorted from help desk. That is what they can do. To our practical experience, it is not stopped. It is properly working. We are getting the LUTs file. We are getting the refund applications file. So I don't see any challenges from the system perspective. There could be some internal technical configuration that might be required to change. So they can take it up with help desk. This is what.
All right. Thank you, Bhadresh and Lucky. One question which we have is there any clear clarification on advance tax in this financial year? Neeraj, would you want to pick that up?
Yes, so there is no clarification, as we had a question just now on that whether the reduced TDS rates are going to help the taxpayers. And I answered that by saying that although there is no relaxation in the advance tax provisions, yet what will happen in the interim, there will be some additional liquidity in the hands of the taxpayers. And my belief is, if we look at the overall scenario, the profitability of the businesses are not going to be as they were in the past. And I am sure the reduced TDS rate would be sufficient to take care of those profitability, and there would not be any additional requirement of payment of advance tax beyond the TDS. Having said that, even if there are some additional advance tax to be paid over and above the TDS, my personal belief is for the first 2.5 months of a quarter, the taxpayers do have some additional liquidity available to them.
All right, thank you. I think given the paucity of time, I'll just take up one last question and then we can move to the closing remarks. This is again with regards to MSMEs. The limit has been raised for MSMEs. Can the company register as per the new limits announced? The website today is also showing the old limit. And has this been notified through a public circular?
Yes, there is, as far as the website is concerned, website is still showing the old limits, and the registrations applications can be filed only in the old application format. The new form should be notified, I think, very shortly. It should happen.
All right. Thank you very much. I think that's the time that we have right now. For the remaining questions, we will address them separately. I hand it over again to the ICC for the closing remarks.
Sir Ramkumar, sir.
Yeah. Good evening, all of you. And am I audible?
Yes, sir.
Hello.
Yes, sir, you're audible.
Yeah. 1 second, sir. Yeah. Good evening. And I'm on behalf of Indo-American Chamber of Commerce. I wish to thank SKP and all the distinguished speakers for the day, for the very, very elaborate discussion that we have had and your patience in answering every question that we have. Now, just before, rather than giving a word of thanks, I'd just like to share with you a couple of trends and, generally what is the general perception of the kind of relief that was given by the government on COVID. Now, there are two issues involved here. One is macroeconomics and the second is microeconomics. Several countries of the world, including the United States of America, the United Kingdom, Australia, China, and other countries, including the developing ones, as well as India, have responded in different ways. Now, most of the European countries and United States have given a lot of relief by keeping in mind the microeconomics of the management of their economies. Whereas India is very peculiar in its own context and its complexion. Here we have a large number of consumers, possibly the second largest in the world. We have a lot of migrant labor. We have a lot of agricultural labor in our country. And so, obviously, there are two routes I'm sure any economics specialist would consider. That is to give, there are basically three angles to providing relief. One is funding, lending, and relief. When you talk about funding, it's putting money in the hands of consumers, which will in turn take the spending to be the main key driver of the growth of the economy or revival of the economy. The second is the lending part. I'm sure that the present relief measures that we've given in India are more in the form of lending rather than funding. And the third part of it is concrete relief. Now, here again, there are two parts. Relief to the industry per se is different from giving relief to MSME. When you're talking about relief, see, let's take, for example, the automobile industry. Now, today, there is a surplus stock, and giving any financial support or relief to the automobile industry, for example, would cause, definitely it will not drive the economy forward in the short term. So my humble submission is, if at all these reliefs are measured in a way where you can get a deferment of taxes, a relaxation of taxes, as well as reliefs in compliances, I think a combination of three would have definitely helped the MSMEs. Now, I would request the professionals of SKP to possibly make a short summary in the way of presentation to IACC members, where all the three are encompassed. And that will give us a very clear understanding as to how we should respond to the government's initiatives. I think, having said this, I'm sure that with your expertise and experience, maybe a possible helpline for our members would definitely do us a lot of good, because I'm sure with this presentation more questions would arise than even finding solutions, and you are the best to give us a guidance. With these few remarks, I would like to thank the august audience who are present here, who are pretty large in number, as well as the office bearers and officials of IACC to be present here, and thanks to each one of you for making this to be a very productive evening for us. Thank you very much once again.
Thank you, sir. Thank you all. Thank all the speakers, and thank you so much.
Thank you.
Thank you. Thank you, everybody.
Thanks, everybody. Thank you. Take care. Bye.
Thank you, everyone.
Thank you.
Thank you and stay safe.
Thanks, Jugal. Take care. Bye.